Hello. Last night's budget. We all saw Joe Hockey's speech, I'm sure, and to be honest, it was fairly uneventful. There were changes announced relating to things like the allowable caps for certain fringe benefits, the tax deduction of work-related car expenses, the way in which SMSFs are penalised for non-compliance, and also the way employee share schemes are going to be taxed. Now, also proposed were changes in terms of the continuing entitlement to an Australian social security payment whilst outside the country. And at the same time, the budget spoke about those that might be enjoying working holidays in Australia and the fact that they will have to pay more tax. Effective 1st of July 2017, childcare reform will see families with incomes of around $65,000 or less and who don't meet the imposed activity test become eligible to receive up to 24 hours of subsidised care per fortnight. To be eligible, though, children must attend an approved childcare service and must be fully immunised. This benefit will be paid directly to childcare providers under the proposed arrangements rather than to the parents of carers directly. For small businesses with an annual turnover of less than $2 million, the proposal is that from July 2015, so not far away, the company tax be reduced from 30% to 28.5%. Effective immediately, these small businesses also for a period of time will be able to deduct the cost of assets purchased up to $20,000. From the 1st of January 2016, changes are proposed to the way in which the Centrelink deductible amount of defined benefit pensions is calculated. Now, this change creates the potential for a fall in social security entitlements for some. The proposal that will affect those in receipt of payments such as age pension and carer payment is the potential restructure of the lower and upper thresholds of Centrelink and Department of Veteran Affairs asset test. Now, if passed, this change will be effective in January 2017 and will mean, for example, that a homeowner couple can have up to $375,000 in assessable assets and still receive a full age pension. But if the assessable assets are more than $823,000, they will receive no pension at all. Additionally, for those who exceed the lower asset test threshold, the tapering rate will change from $1.50 per $1,000 reduction to $3 per $1,000. So what does that mean? Based on the info we have at this point and using only those asset test thresholds as a guideline, we make the following observations. So a single pensioner who owns their home, has assets of less than $289,500 will receive an increase in their pension. Those with a higher level of assets than that will receive a reduction. A couple pensioners who own their own home and have assets of less than $451,500 will receive an increased pension, and those with a higher level of assets will receive a reduction. Now, what this means is that between now and the proposed effective date of the 1st of January 2017, a review of your assessable assets and income will need to be undertaken to determine the impact of this change on your cash flow. So for my clients listening to this, an analysis for you will be undertaken at your next review meeting. Another area that gives rise to the need for forward planning is the proposal to change the way aged care residents are assessed. Now, currently, if an aged care resident rents out their former home and leaves some of their refundable accommodation deposit outstanding, the rental income they receive is exempt from the means tested care fee. After the 1st of July 2016, though, it's proposed for this exemption to be removed and the rental income will then be assessed. Finally, despite much discussion in recent times, there will be no change to personal income tax rates and no change to superannuation law. Treasury was very clear last night that there would be no new superannuation tax introduced under the current government anyway. So for now at least, the status quo remains. Tracy Ferguson, thanks for listening.